Please confirm you can hear me clearly.
Yes, good evening. We can hear you.
Can hear you.
Good evening. We can hear you, sir.
Ahmed.
Good evening, sir.
Yeah, good evening. Yeah. All right, our last topic. Our last topic is risk management. A quick recap of the topic we have treated. We have treated source of finance, number one. We look at finance success. We look at capital structure, dividend policy, financial statement analysis. We look at capital rationing and asset replacement. We are rounding up the topic with risk management. Chioma, please, can you mute? Thank you. Under the risk management, we shall be discussing foreign currency risk management and interest rate risk management. Tonight, we are looking at currency risk management. Why is this topic important to all accountants? Why is this topic so important to all accountants? The world is a global village. Nigeria transact business with other countries in the world. Other countries in the course of transacting business with one another, need for conversion of currency. Nigerian currency is naira. US currency is dollar. Individual country has its own currency, and the value is not the same. 1 naira is not equal to $1. 1 naira is not equal to £1. Therefore, there is need for conversion of currency. This gives rise to currency risk management. We have the foreign currency markets, the foreign exchange market, a market where you can buy or sell foreign currency. The foreign currency market is a market involves electronic trading of foreign currencies between banks, dealers, and businesses. At this market, investors can buy currency or sell currencies. At what rate can we buy currency or sell currency? Because currency value is not the same. That gives rise to exchange rates. What is exchange rates? Exchange rates can be defined as the number of units of a given currency that can purchase 1 unit of another currency. Exchange rates. Let me define it again. Exchange rates, the number of units of one country currency one unit of another country currency. For example, 1,500 naira to $1. For example, if I say 1,500 naira equal $1, that means number of naira that can buy 1 unit of dollar. The number of units of naira that can exchange for 1 unit of dollar is the exchange rate between naira and dollar. So if you ask yourself, how many naira do I require to buy $1? That is the exchange rate between naira and dollar. How many naira do I require to buy £1? That is the exchange rate between naira and pound. Exchange rates can either be direct or indirect. Exchange rates can be stated either direct or indirect. Let us explain indirect quotation. There are 2 ways to quote exchange rates. Exchange rates may be quoted directly. Let us explain direct quotes. Direct quotation This is when the exchange rate is stated in terms of the number of units of local currency that can exchange for 1 unit of foreign currency. Direct quote. It is very important you get the explanation now. Direct quote. This is when the exchange rate is expressed or stated in terms number of units of domestic currency that can exchange for 1 unit of foreign currency. For example, if examiner says examiner says 1,200 naira per $1. Naira is our local currency. Therefore, dollar is the foreign currency. Number of units of naira that can buy 1 unit of dollar. This is direct quote. Direct quotation. Naira is quoted directly to dollar. Or you can have $1 equal 1,200 naira. This is still direct quote. Direct quotation. The quantity of naira that can buy $1. The quantity of local currency that can buy foreign currency. This is direct quotation. Indirect quote. Indirect quote is the opposite of direct quote. The opposite of direct quote. Indirect quote. This is when the exchange rate is stated in terms of the number of units of foreign currency that can exchange for 1 unit of local currency. For example, if examiner says dollar $0.0025 per 1 naira, the quantity of dollar that can buy 1 unit of naira. In this case, local currency will take 1. Foreign currency could be more than 1 or less than 1. You require $0.0025 to buy 1 naira. So please, you must identify local currency. You must identify foreign currency. The illustration we have given, it is very easy to identify local currency because naira is involved. What happens if the two currencies given in the exam, naira is not involved? Assuming the examiner gave you currency dollar and pounds. Assuming the examiner gave United States dollar and British pound sterling in the question. How do you determine foreign currency and local currency? Because one must be local, one must be foreign. Please note, where the company is located, where a company is located, the currency of that country becomes the local currency. For example, a company located in UK is to buy products from US. A company located in UK is to buy products in US. Because the company is located in UK, therefore, UK, British pound sterling becomes our local currency. Why United States dollar is the foreign currency. Please keep this, maybe in your left palm. Where a company is located, the currency of that country is the local currency. All right. Relationship between direct and indirect codes is reciprocal. Relationship between direct quotes and indirect quotation is reciprocal. That is, indirect quotes is equal to 1 over direct quotes. direct quote is equal to 1 over indirect quote. Also, direct quote is equal to 1 over indirect quote. So please note, relationship between direct quotes and indirect quotes is reciprocal in nature. Our next discussion. Bid price and offer price, or you can call it bid rates and offer rates. Exchange rates are usually quoted as a spread between two prices. Exchange rates are usually quoted as a spread between two prices. We have the bid price. The bid price is the buying price. The price at which bank or authorized dealer is willing to buy foreign currency. Your bid price is the buying price. Bid price is buying price. The rate at which, or the price at which a bank or authorized dealer is willing to buy foreign currency. The offer price is selling price. Selling price. The price at which the bank or the authorized dealer is willing to sell foreign currency. Please note, authorized dealer is any individual that is licensed by government to buy or sell foreign currency. Authorized dealer. Authorized dealer is any individual or corporate body that is authorized by the government to buy foreign currency or to sell foreign currency. For example, Aboki FX. Aboki FX is an authorized dealer. For just 1 minute. So please note, The difference between the bid price and the offer price represent profit. That is the profit margin to the authorized dealer. All right. We have explained what is foreign currency. We have explained exchange rates. We explained direct quotation, indirect quotation. We have explained bid price versus offer price. Our next discussion, the rules. Please let me expand this more. The rules for the buying and selling of foreign currencies. What are the rules that govern foreign currency purchase or sales? 1. Exchange rates are quoted from the viewpoint of the bank. That is, exchange rates are quoted to favor bank or the authorized dealer. The way the exchange rate is quoted, it is designed to favor the bank or the authorized dealer. 2. When the customer buys, then the bank sells. And when the customer sells, the bank buys. Let us explain this number 2. When the customer is willing to buy foreign currency, then bank will sell foreign currency. In that case, the customer is the buyer. The bank is the seller. Alternatively, when the customer is willing to sell foreign currency, the bank will buy foreign currency. In the second situation, or the second case, the customer is the seller. Bank is the buyer. Please note, there must be a buyer. There must be a seller. You must identify the buyer and the seller. Rule number 3. Rule number 3. In a direct quote, the bank buys at low rates and sell at high rates. Let us explain that briefly. If the exchange rate is quoted directly, that is number of local currency per one foreign currency, that is direct quotation. The bank will buy at lower rates, a rate that is very low, and sell at a rate that is high. Rule number 4. In an indirect quote, the bank buys at high rates, a higher rate, and sells at low rates. Please, ladies and gentlemen, for this exam, until you qualify, you are going to memorize this rule. You are going to memorize and internalize the rule. Exchange rates, currency management is very important to you. All right. Terms and terminologies. Spot rates. Want to look at the terms that are peculiar to foreign exchange rates or foreign currencies. Number 1 is spot rates. Your spot rate is the exchange rate for immediate foreign transaction. Your spot rate, the exchange rate for immediate foreign transaction. For example, assuming you are to buy dollar now, assuming you want to buy dollar now at the moment, the exchange rate between naira and dollar at the very moment is called spot rate. Number 2, forward rate. Forward rate is the exchange rate of two currencies. Exchange rates between two currencies set on one particular day for delivery at future specified dates. Forward exchange rates. Let us break it down. Exchange rates between two currencies. Set on a particular day for delivery at a future specified date. Let us illustrate briefly. You have to make payments. You have to make payments in dollars. In 3 months' time. In 3 months' time, you need to make payments in dollars. We are in April. Today is 8th of April. And you have to make a payment in dollars in 3 months' time. That is, you are going to make payments in July in dollars. You can approach your bank today. You can approach your bank today to obtain an exchange rate between Naira and dollar. You are going to obtain a rate today between Naira and dollar for the payment you are going to make in 3 months' time. That is forward exchange rate. The forward exchange rates are often quoted at a discount or at a premium. The forward exchange rates are often quoted at a discount or at a premium to the spot rate. When your forward rate is higher than the spot rate, this implies that the spot rate is quoted at a premium forward. When your forward rate is higher than your spot rate, it implies that the spot rate is quoted at a premium forward. But if your forward rate is lesser than the spot rate, it means the spot rate is quoted at a discount forward. Last diet, examiner tested 20 marks for a year. forward contract hedging. Let me copy this closer here. So we have explained spot rates. We have explained forward rates. The forward premium or discount is often calculated as an annual percentage deviation. Annual percentage deviation from the spot rate. If you want to calculate your annualized forward premium or discount, pick your forward rate minus your spot rate divided by the spot rate, multiply by 12. 12 represents 12 months in a year. Then divided by number of months forward. Then multiply by 100. Number 3, cross rates, cross exchange rates. Deliberately, we are not rushing this class. You've got to understand the concept of foreign currency. Cross rates. This is the implied exchange rate between two currencies. The implied exchange rate between two currencies based upon the explicit relationship, the explicit rates between the third currency it is the exchange rate between two currencies derived from their exchange with a third currency. We got to illustrate this. We have to illustrate cross rates. You can note this. Let us explain with triangle. Naira to dollar. $500 naira to $1. Yen Japanese yen to dollar. $100 Japanese yen to $1. There's exchange rate between naira and dollar. 500 naira equal $1. There's exchange rate between Japanese yen and dollar. 100 Japanese yen equal $1. But there's no direct exchange rate between naira and Japanese yen. There's no direct exchange rate between Nigerian naira and Japanese yen. We said cross rates, implied exchange rates between two currencies, naira and yen. Derived from their relationship, derived from their exchange with the third currency. The third currency in this question is dollar. There's exchange rate between naira and dollar. There's exchange rate between yen and dollar. What is naira to yen? How many naira do I require to buy 1 yen? Just 1 minute. Sorry for the break. Sorry for the break. So you don't have exchange rate between naira and yen. You can derive it. If I want to get naira to yen, look at it, please. $500 naira equal $1. 100 yen equal $1. What is naira to yen? Naira is 500. Yen is 100. Divide. That means 5 naira equal 1 yen. I require 5 naira to buy 1 yen. We are able to derive this by looking at the relationship with dollar. This is what we call cross rates. All right. Any question, please? Before we proceed. Chioma, I hope you are much better now.
Yes, sir, I'm better. Good evening, sir.
I miss you.
I miss you more, sir. I'll be in class on Sunday.
Let's hope so.
Hello, sorry, good evening. Please, could you explain the cross rate thing again between the dollar, the way you explained it earlier.
All right, cross rates. All right, let me note that. Any other question so that I can take it simultaneously? We need to explain cross rates again. All right, that is the only question. Cross rates, we said implied exchange rate between two currencies derived from their exchange with a third currency. Implied exchange rate between two currencies, say naira and yen, derived from their exchange with a third currency, say dollar. That is cross rates. All right. Appreciation and depreciation of currency. Currency appreciation. Currency depreciation. What is currency appreciation? Currency appreciation is a situation where the units of domestic currency needed to buy 1 unit of foreign currency decreases. Let me take that again. Currency appreciation occurs when the units of local currency needed to buy 1 unit of foreign currency reduces. That is currency appreciation. For example, March. In the month of March, 1,500 naira equal $1. In the month of April, 1,200 naira equals $1. What has happened to naira? The number of units of local currency to buy 1 unit of foreign currency decreases. In this case, we say naira has appreciated relative to dollar or against dollar. The number of naira needed to buy $1 is falling. In that case, naira is appreciating. Currency depreciation. This occurs where or when the units of domestic currency required to buy 1 unit of foreign currency increases. In that case, we said there's currency depreciation. For example, in the month of March, 1,500 naira equals $1. In the month of April, 2,000 naira equal $1. What has happened to naira, please? The number of units of naira required to buy 1 unit of dollar is increasing. We require more naira to buy the same dollar. In that case, naira is depreciating. All right. Next discussion, theories of exchange rate determination. What are we trying to discuss here? We should ask ourselves as accountants, why is it that 1 naira is not equal to $1? After all, they are just one note. 1 note of naira, 1 note of dollar. 1 note of naira, 1 note of pounds. Why is it that currency values are not the same? Some currencies are stronger, some are weak, some are weaker. Something must be responsible for this. This theory will explain why currency values are not the same. We call it the 4-way equivalence. The term 4-way equivalence refers to 4 concepts that together provide a consistent explanation for changes in foreign exchange rates. The 4-way equivalence refers to 4 theories, 4 concepts that together provide a consistent explanation for changes in exchange rates, for fluctuation in exchange. What are these theories? Number 1, purchasing power, parity theory, interest rate parity theory, the Fisher's theory. That is the Fisher's effect. And you have the expectation theory. Please, examiner can choose to ask you theoretical questions. This explanation, this notes is available in your study pack, page 167. What am I trying to say? You need to read and understand the theories. All right, let's go to the first one. Interest rate parity theory. This theory states that the exchange rate between two currencies. This theory states that the differences in exchange rates between two currencies, the differences in exchange rates between two currencies occurs as a result of differences in interest rates. As a result of differences in interest rates between the two currencies. According to this theory, a country with higher interest rates we have its currency value depreciating. A country with higher interest rates, we have its currency value depreciating faster compared to a country with check interest rates in Nigeria, check interest rates in US. If you check interest rates in Nigeria and United States, interest rate in Nigeria is 26. Currently, we have 26.5. As at February 2026, interest rate in Nigeria is 26.5%. Interest rate in US is maximum of 3.5%. Look at this, please. Look at what this theory is saying. Nigeria, interest rates, 26.5%. If you check online now, USA, 3.75. According to interest rate parity theory. A country with higher interest rates, we have its currency value depreciating faster compared to a country with low interest rate. Please look for the difference. The difference, please. 26.5 minus 3.75. What do we have?
$22.75.
Real one, I can hardly hear you. What do you say?
22.75.
22.75.
22.75%. According to this theory, Naira will depreciate Naira is expected to depreciate by 22.75% relative to dollar. That is what the theory is telling you. That the reason why currency value is not the same is because interest rates are not the same between countries. Where interest rate is high, value of the currency will fall. The interest rate parity theory can be used to forecast the interest rate parity theory can be used to forecast future exchange rates between two currencies. If you are giving interest rates, we know the interest rates in Nigeria. We know the interest rates in US. And we are giving spot rates between Naira and dollar. We can forecast exchange rate between Naira and dollar. You can do 3-month forecast, 6-month forecast, 1-year forecast. We can forecast what the exchange rate will be between Naira and dollar in 1 year's time. With the equation below. Look at this equation. For direct quotes, your equation becomes 1 plus FIR divided by 1 plus DIR is equal to X over F. For indirect quotes, the formula will change slightly. 1 plus FIR over 1 plus DIR is equal to F over X. Okay. There's a question from Adejimi Olalekan Favor. Is interest rate regulated by governments or market forces or market function? Both are involved. At times, government comes to regulate interest rates. At times, the interplay of the market forces, the interplay of the market forces, that is, the interplay of demand and supply, demand for loanable fund and supply of loanable fund. We have demand for loanable fund. We have supply of loanable fund available for loan. So, Olamilekan, market force, we have impact. Government regulation. In some economy, government does not interfere with the market. Mostly capital markets economy. In a pure capitalist economy, government will not interfere with interest rates. But no country will live its economy entirely to the market force. All right. Let's define the variable. FIR, foreign interest rates per time period. DIR, domestic interest rates per time period. Your X, that is the spot rate. Your F is the forward rate. So please note this. Please note this. We are not sure what the examiner will text. But by the design of this your syllabus, your exam must reflect international standard. ICAN is recognized in Canada. In UK. So ICAN will do everything possible to make sure the exam reflects international standard. Number 2 theory, purchasing power, parity theory. This theory argues that exchange rates between two currencies depends on the relative inflation rate. Relative inflation rates within the respective countries. Let us expand that. The purchasing power parity theory states that the differences in exchange rates, the differences in exchange rates between two currencies occurs as a result of differences in inflation rates between the two countries. According to this theory, a country with higher inflation rates, a country with higher inflation rates, we have its currency value depreciating. A country with higher inflation rates, we have its currency value depreciating faster compared to a country with low inflation rates. If you go online, check inflation rates in Nigeria. Check inflation rates in US. In Nigeria, inflation rate is 15.06% as at February. In United States, as at February, inflation is 2.4%. You can begin to understand why Naira is falling in value. The difference between the two, 15.06 minus 2.4. 12.66. Naira is expected to depreciate by 12.66% relative to United States dollar. This is what the theory is talking about. Purchasing power. Your purchasing power is affected by inflation. Your purchasing power is your currency value. Your currency value is affected by the inflation rate in your country. We begin to appreciate why 1 Naira cannot equal to $1. Inflation rate is not the same. Interest rate is not the same. Why would Naira and dollar be the same? The purchasing power parity theory can also be used to forecast exchange rates. We can use it to forecast. We know inflation in Nigeria. We know inflation in US. And we can determine the spot rates between Naira and dollar. We can determine the spot rates between Naira and dollar. Then we can forecast exchange rate between dollar and Naira. If you check online now, the exchange rate between Naira and dollar, 1,425 Naira to $1 at the black market. Official rate, 1,382 to $1. $1,382 equal $1. This is the spot rate. Then you can forecast forward rates. For direct quotes, you can use equation. The equation of purchasing power, 1 plus Fi divided by 1 plus Di is equal to X over F. Your Fi, foreign inflation. Your Di, domestic inflation. Your X, spot rate. Your F, forward rate. For indirect quotes, the equation will change slightly. If you are given indirect quotes, the equation becomes 1 plus Fi divided by 1 plus Di is equal to F divided by X. Right? Just 1 minute. I want to add something to the file quickly. It's important Please, just 1 minute. I want to add something and explain it. I must have deleted in error in the course of. Okay. Let me see. I want to explain the Fisher's effect. Let me see. Okay. Okay, let's continue. I will still give you the notes. The Fisher's theory. We also call it the Fisher's effect. The Fisher's theory uses the combination of interest rates and inflation rates to explain the reason for differences in currency value. The Fisher's effect uses combination of interest rates and inflation rates to explain currency values. And according to the Fisher's effect,
Sir, can you come again? So explain what?
and don't worry, I'll come, definitely I'll come again, volatility risk. I'm even trying to get it across to that place to make it much easier. I will surely come again, don't worry. In the course of trying to compile my notes, I think I deleted in error. That was what happened really. I will surely come again, don't worry. All right. I've gotten the notes. Sorry, it was a temporary network glitch, but we are back. That was a temporary network glitch. So I have to reshare. I have to reshare my material. Then we can move on. All right, let me reshare this material now. Yeah, let's go. The Fisher's effect. The economist Ivan Fisher developed the Fisher's theory. The Fisher's theory uses the combination of interest rates and inflation rates to explain the reason for differences in exchange rates between two currencies. According to the Fisher's theory, differences in inflation will affect interest rates. Interest rates will affect currency value. According to the Fisher's theory, let me try to break that down. According to Fisher's theory, interest rate is not equal between Nigeria and US because inflation rate is not equal. Inflation rate will affect interest rate. One of the factors that affects interest rate determination is inflation rate. So if inflation rate is not the same between two currencies, definitely interest rates will not be the same. If interest rate is not the same, currency value will differ. Fisher's theory uses the Fisher's equation. Look at the equation. MCC, which should be used to this equation. 1 plus MCC is equal to bracket 1 plus RCC bracket 1 plus I. This is the Fisher's equation. Where your MCC, money cost of capital, a cost of capital with inflation. RCC, cost of capital, a cost of capital without inflation. I, inflation. What this theory is saying in summary is that the major reason why currency value, why exchange rates fluctuate is because of inflation. Inflation affects cost of borrowing. If there is no inflation, assuming there is no inflation, cost of borrowing in Nigeria will be cost of borrowing in US. Assuming there is no inflation, the cost of borrowing in Nigeria will be cost of borrowing in United States because there's inflation. Nigerian inflation is higher. That will affect Nigerian cost of borrowing. Nigerian cost of borrowing will be higher. If our cost of borrowing is higher, value of our currency will fall. Clementina, I don't know this person. No. Wow. The last theory. Expectation theory. The expectation theory is the theory that all relevant information is reflected in the market rate of exchange. Exchange rate reflects relevant information. Therefore, the forward rate between two currencies, what the exchange rate will be in future between two currencies, reflects market expectation about the spot rate, about what the spot rate will be in the future. Let me try to put small illustration to it. What the exchange rate will be between Naira and dollars in 6 months' time reflects market expectation about what Nigerian spot rate will be in the future and what dollar spot rate will be in the future. To better appreciate this theory, to better appreciate this theory, market expectation or expectation theory, if I ask the class, if you have a choice between accepting Naira and accepting dollars, which one are you going to pick? Let me hear from you.
I'll pick dollar, sir.
Read one. Dollar.
I'm going to pick dollar, yeah.
Why are you picking dollar?
All right, so I'm going to pick dollar because the market exchange rate of dollar, I mean the value, is much more than the Nigerian one, sir, the Nigerian currency.
Is because everybody will pick dollar because you trusted that the future of United States is brighter. At least from woman angles. Nobody will pick Naira. You want to maintain your investment in dollar. because the future of that currency is much more brighter. That will affect exchange rate between the two currencies. Wow. We have like 30 minutes. It's obvious that we cannot solve any question tonight. But if you can finish the explanation, at least our next discussion, foreign currency risk. What is foreign currency risk? Foreign currency risk is the risk of an adverse movement in exchange rates. The risk of an adverse movement in exchange rates over a credit period. The risk that the exchange rates will fluctuate negatively, adverse. When you say foreign currency risk, is the risk that exchange rate will fluctuate negatively over a credit period. Foreign currency risk faces exporters who invoice in foreign currency. Exporters who invoice in foreign currency. And two, importers who pay in foreign currency. Assuming you export your produce to US and you quoted your invoice in dollars. That means your customer will pay you dollars. You are exposed to foreign currency risk. By the time you get your dollar, you want to convert to naira. That means you are exposed to foreign currency risk. Exchange rates can be very volatile. That is, exchange rates can fluctuate, moving up and down by a large amount. Within a short period of time. Exchange rate volatility creates foreign exchange risk or foreign currency risk for anyone involved in buying, selling, borrowing, or investing in foreign currency. Currency risk can be classified into three. currency risk can be classified into three. You have translation risk, economic risk, and transaction risk. Foreign currency risk can be classified into three. You have translation risk. It's also called translation exposure. Translation exposure. Translation risk arises in international companies. International companies with foreign subsidiaries. Income statements and statements of financial position will be denominated in the local currency of the subsidiary. The income statement and statement of financial position will be denominated in the local currency of the subsidiary. And on consolidation, will be translated into the currency of the parent company, the holding company. In the process of translation, translating financial statements from one currency to another currency, this can lead to exchange losses, or exchange gain. Arising as a result of exchange rate fluctuation. Translation risk is therefore the risk of losses or gain arising on the translation of the financial statements of foreign subsidiary into the currency of the parents for the purpose of preparing consolidated accounts. This is repetition. Let us illustrate this briefly. Look at Mobil Oil. Mobil Oil Corporation is a multinational company. Mobil Oil is a multinational company. The parent company is in US. Let me illustrate this with a small diagram. Mobil oil. Parents company in US. We have subsidiary. We have Nigerian Mobil oil. Account is maintained in Naira. We have Ghana. Mobil oil. Account is maintained in cities. You have Mobil oil. South Africa. Account maintained in rand. At financial year end, the parent company will prepare consolidated financial statement that covers activities of all foreign subsidiaries. In that case, assets and liability of Nigerian Mobil oil denominated in Naira will be converted to dollar, currency of the parent. Asset and liability of Mobil oil Ghana, denominated in cedis, will be converted to the currency of the parent. Mobil oil South Africa, asset and liability maintained in rand will be converted to dollar. In the process of translating, the currency of the subsidiaries to the currency of the parents, that will give rise to exchange loss or gain. This is called translation risk. Number two, economic risk. Economic risk in the context of foreign exchange is the risk that a company might lose or might choose to locate its operation in a country whose currency gain in value. A country whose currency gain in value over time against the currencies of the competitor. The consequences of increase in value of domestic currency is a loss of competitiveness. Let me explain this one. Economic risk is a risk arising from exchange rate volatility. Please, when we say volatility, fluctuations. Where exchange rate fluctuates. Economic risk is the risk arising from exchange rate fluctuation that can affect or that can reduce the present value of a future cash flow. It can reduce the present value of a future cash flow. It can affect ability of a company to compete with other companies at the international level. This economic risk can affect ability of a company to compete. It can affect the international competitiveness of a company. It can also affect remittances from the foreign subsidiary to the parent. Oh. Multinational companies are highly exposed to economic risk. If I take an example, look at Dunlop Tire PSC. We have Dunlop Tire, Nigerian Dunlop, and we have Dunlop Tire, Ghana. If you manufacture tire in Nigeria, your operating cost is very high. Inflation is high, cost of borrowing is high. So it's more expensive to manufacture tire in Nigeria. Dunlop decided to relocate to Ghana because cedis is appreciating in value. Then lastly, we have transaction risk. Transaction risk is the foreign exchange risk that arises between two parties. Transaction risk is the foreign exchange risk arising between two parties. In the ordinary course of business, this risk arises when the normal transaction currency of each party is different. Please listen to this. Transaction risk arises because the normal transaction currency of each party is different. And the transaction involves future receipts or future payments. Transaction risk is the risk that for any future transaction in foreign currency, for any future transaction in foreign currency, the amounts received or paid in domestic currency may be different from the amounts originally expected. Because of fluctuation in exchange rates. Because of fluctuation in exchange rates, between the dates volatile exchange rates increase transaction risk. You are based in Nigeria. You have to make payments in dollars in 3 months' time. That is, you purchase raw materials from your supplier in China. Today, you made a purchase of 50 from your supplier in China. And your supplier says you can make payments in 1 month's time. Because of timing difference, you enter into a contract today. You are making payments in 1 month's time. That means there's a time difference. There's a timing difference between when foreign transaction is consummated. There's a timing difference between when foreign transaction is consummated and when actual settlement is done. That is transaction risk. Wow. We have like 10 minutes, okay? Let me try to explain this. Now we have discussed the different type of currency risk, transaction risk, economic risk, translation risk. We are aware involved in exchange rates, and this can affect companies. Our next discussion is how can company protect itself against exchange rate fluctuation? How can companies protect their investments? That takes us to hedging, exposure to foreign currency risk. What is hedging? Hedging means protecting your investment against exchange rate volatility. The purpose of hedging and exposure to risk is to eliminate or reduce the possibility that actual results will turn out worse than expected. Hedging method can be classified or can be categorized into two. Your hedging measure can be categorized into two groups. We have the internal measures. The internal measures is also called non-financial measures. And we have the external measures. The external measures are the financial measures. Okay, although I wish to finish this aspect. Let me stop the explanation here. We have just like 5 minutes. So these 5 minutes, let me hear any comments, any question, any clarification. So let's stop the class here. So that we get. All right, if there's no question.
Mr. Shoraju? Mr. Shoraju?
Yes, sir.
Yeah, there is question. Yeah. So the thing, what's it called again? The edging and what's the other one? Sports and forward rate. So you said sport is the at the moment, right? And the forward is this something like in the future? So how is forward and
It's
is
breaking, or
forward
is it
almost?
my line?
I think it's me that is breaking. Is forward rate and edge similar, or is there something that is I'm not getting clear out of the two?
Because your
Hello?
line is breaking, I can't pick your question.
Mr. Shadi is
Can you
not
hear me
here.
properly? Can you hear me now?
Okay, you can start again.
Okay, so I was saying that the spot, the way I understand it is at the moment transaction, and the forward rate is a rate in it that both parties are agreed to transact in the future time. Would that also be termed like edging in that wise?
We are still coming to it.
Oh, okay.
That's actually edging. We are still
Okay, so
coming
forward.
to what you said.
Okay. Thank you.
I don't want to extend the class beyond 11. So we are still coming to that discussion. Under edging, we are still going to discuss what you mentioned.
Mr. Shoraju.
Yes.
Okay, good evening, sir. Can you please explain economic risk? Do you
Maybe
get
I'll
that?
put an explanation now.
Sir?
Economic risk. I
Okay.
said maybe I'm going to put illustration to it now.
All right.
Economic risk. The risk, a risk of exchange rate fluctuation that can reduce present value of future cash flows. It can also reduce remittances from foreign subsidiary to the parents. This risk can also affect the international competitiveness of a company. As a result of fluctuation in exchange rate, adverse fluctuation. Let me try and illustrate this. Look at Mobil Oil. Mobil Oil is a multinational company that is based in US, Nigeria. At the end of the year, we remit profits achieved to its parent company in US. Now, Nigerian mobile oil account is maintained in Naira. That means that remittance in Naira will be converted to dollar and sent to US. Because Naira has depreciated in value. If you convert Naira to dollar, it makes no sense to the parent company. Their economic risk has affected remittances from subsidiary to the parent company. As a result of adverse fluctuation in exchange rate, remittances from foreign subsidiary to its parent company is being affected because value of Naira has fallen against the value of the parent company. Now, if Mobil Oil Nigeria want to remit returns to Mobil Oil US, we need to convert that returns in Naira to dollar. By the time you convert Naira to dollar, the dollar amount simply because Naira currency has fluctuated negatively. Economic risk, it can affect. Please, can you meet somebody is disturbing this class?
I took my daughter back to my
Mama,
parents'
can
house
you
for
mute?
spring festival. At the dinner table, Mom set a whole chicken down, one drumstick for each kid. Outsiders can't have any. I grabbed a drumstick for my daughter. My brother lost it right away. Ian, are you deaf or something? Mom said outsiders can't eat those. What's my son supposed to eat if you take it?
Thomas,
Nephew started
she has slept off. She's not going away.
Mom just sat there quiet, head down. Dad was drinking and complaining. Said I had no manners at all now that I'm older. Accused me of letting my daughter fight my nephew over food. My brother's 25 and home, but he's not married yet. He's still just a kid. I froze. I realized Mom was throwing shade at me this whole time. I quietly.
Hello. Huh? Oh,
Please, can you mute? Aye, thank God. Aye. So that is one aspect of economic risk. The second aspect, economic risk can affect international competitiveness of a company. We gave the example of Dunlop. We have let me come here small. We have Dunlop Nigerian PSC. We have Dunlop Ghana PSC. Both companies manufacture tires. Dunlop Nigeria manufacture tires in Nigeria. In Nigeria, Naira has depreciated. Inflation rate is high. Interest rate is high. Currency value is weak. So if you manufacture in Nigeria, your cost of manufacturing is very high. to manufacture tire in Nigeria. The cost of production is high. To manufacture tires in Ghana, cost of production is low. If the two companies should take tires to the international market, Dunlop Nigeria, because it's located in Nigeria, will not be able to compete internationally with Dunlop Ghana. Economic risk has affected Nigerian Dunlop. The third aspect of economic risk. Economic risk can reduce present value of future foreign cash flows. Because there is adverse fluctuation in exchange rates. Multinational company is highly exposed to economic risk. That's the explanation surrounding economic risk. We got to close the class. May God give us a better understanding. I'll be checking out. Any other question, clarification?